Hello, my name's Stephen Oxley. I'm Vice Chairman of PAMCO. PAMCO is a global alternatives asset manager in the liquid space. And I'm here today to talk to you with my colleague Lisa Friedman about the global asset management industry, its development, history, and some of its characteristics. So what is asset management? It's a question that many people ask and sometimes confuse it a little with investment banking. And although investment banks do own asset management firms, asset management is a discipline and a business entirely separate from it. It's had a long development and gestation. But I'll come on to that in a moment. First of all, some definitions. So asset management is the direction of clients' cash and securities by a financial services company. Asset managers usually have discretion. Discretion means that they have the power to make investment decisions on behalf of their clients. So the client hands over that ability to the asset manager. There are two basic forms of asset management, active and passive. Active management is where the manager is making distinct decisions about which securities and which markets to invest in on behalf of their clients. Passive management is usually run by a machine and is based on following a particular market or index in the proportion of the securities within that index. As it indicates, it's passive, it requires less work, and therefore it costs the investor less. There are also two types of active management, fundamental and technical. Fundamental assessment of securities is based on the skill of the manager to analyze economics and the fundamentals of different companies and which will outperform the others. Technical analysis uses computer models to guess which markets and securities might outperform. That's a basic overview. Let's look at the history now of the asset management industry. And this slide covers a period of 200 years from the formation of the New York Stock Exchange back in 1817 right through to the formation of the Astana International Financial Center, which will happen next year. All these events have had an impact on the asset management industry. Once people could buy listed securities on the New York Stock Exchange, and America, incidentally, is still by far the largest market for asset management, they were able to make stock decisions and invest either for themselves or employ a professional to invest for them. As we go through time, perhaps a couple of interesting points are worth picking up. The first closed-end fund was formed in the United States in 1893. This was a managed fund. And very shortly after that, something similar was started in the United Kingdom. So asset management was something that had its origins in the Anglo-Saxon world. In the 1920s, there was the stock market crash when there was a huge amount of volatility and people lost a lot of money through their investments. And then if we come through to the current age, in 1949, the first hedge fund was formed in America by someone called Alfred Jones. This was a fund that could go both long and short on securities. And in 1986, the Capital Group opened the first emerging markets fund, which was an attempt to invest outside the domestic markets of Europe and the United States into some of the developing markets. And the story since then has been of institutional investors becoming increasingly important in the asset management industry and for asset managers as pension funds, both in Europe but importantly in North America, grew in size and sought asset managers to manage their assets. We've also seen the emergence of other types of investors, high net worth individuals recently, with the sale of businesses and the development of sovereign wealth funds, usually in countries which have high commodity dependency. So that's a brief history of the asset management industry. Let's move on now to talk about the different players within asset management. So it's important, I think, to make a distinction between the clients and the managers. The managers are the institutions that manage clients' money. If you like, the clients are the owners of capital and the managers manage that capital. It's not their money that they're managing. So who are owners? Well, first of all, they can be you and me, even if we have a small investment in a mutual fund or we make a contribution every month to a pension plan, we are investing with an asset manager. They could be large pension and insurance funds, and many of these funds are very large indeed, multi-billion-dollar funds that are investing securities in order to pay pensions and life insurance contracts at some stage in the future. They could be sovereign wealth funds, which I've already mentioned, or governments, or they could be non-financial corporations who simply want somewhere to put their savings. And the managers are either independent, or they're owned by a bank, or they're owned by an insurance company. And if you look at the ranking of the largest asset managers in the world, they're almost equally split between bank-owned, independent, and insurance-owned institutions. The insurance-owned asset managers obviously developed because they were managing their own money, and now they're offering their services to others. Many of the largest asset managers are listed companies, so you can also invest in asset managers' equity, and they may be controlled by the owners of capital, as is the case with insurance companies, and some pension funds which now have their own asset management firms. Importantly, only about 30% of the total assets out there to manage are managed by asset managers, even though it is a huge and growing industry. This slide looks at the recent development of the asset management industry. So in 2016, it was estimated that the asset management industry was managing nearly $70 trillion of assets. And as you can see from the slide, that's grown from 27 trillion in 2002. So the recent growth of the industry has been significant, and it's expected to continue, maybe not quite at this rate, but certainly at a significant pace. If you look at the pie chart to the right, you can see that there is still a domination by US-based and European-based managers, but there's been faster growth among Asian and non-European and US managers. So what is it that these managers are managing? Well, the world is divided up, the investment world is divided up into different asset classes, and different asset classes have different return and risk expectations. And here we've laid out the expected return and risk from different assets looking forwards based on some estimates made by the world's largest asset manager, which is a company called BlackRock. As you can see, and they're ranked here by riskiness, if you like, or expected riskiness, starting with private equity, which has an expected risk of 24.3%. And this is a standard deviation measure, which I don't want to get technical about, but it's a measure of how likely the asset is to underperform as well as outperform its central expectation. The higher the risk number, the more likely it is you are to lose money as well as make money with these investments. So you start at the top with private equity and you end at the bottom with cash, which is seen as a risk-free asset. And the secret of investing, if you like, and it's not much of a secret, but it's a core tenet, is that if you want to preserve your capital and if you want to reduce your risk, the only free lunch is diversification. Don't put all your eggs in one basket, as we say in the UK, and there's only one free lunch in investment, and that is diversification. So as well as having different long-term risk expectations and characteristics and return expectations, asset classes also behave in different ways in the short term. And this can be measured by another mathematical measure known as correlation. The interesting thing is that if you mix asset classes with different correlations, you end up with a portfolio that for the same amount of expected risk has a higher expected return. And one of the things that asset managers think about a lot for their clients is how to optimize their portfolio, how to diversify their portfolio to give them returns that will be less volatile going forwards. These are the types of mandates that asset managers manage. Here are some examples. We talked about the high-risk private equity world. That's on the top left, venture capital, which is the early stage of private equity. Then there's something called private credit, which is using private company lending or investing in securities or loans issued by private companies. Public equity, which is listed equity. So the New York Stock Exchange, which I mentioned earlier, was the first public equity market. There are now public equity markets all over the world. Fixed interest, which are bonds. These are loans issued by governments or companies or other entities that provide a return on investment in the form of a coupon, which is an interest payment made every year, and a final payment, which is the return on capital that you've invested or lent to the company. And finally, there's currency and cash. We've also seen recently, and this is an area in which me and my colleague are very much involved, the development of alternative assets. Property and real estate, commodities, hedge funds, and infrastructure assets. These areas are of increasing interest to investors, and they're of increasing interest to asset managers, because it's quite interesting to note that the alternative assets are the assets which provide the highest level of income to asset managers. They have higher fees than, for example, passive investing or core equity or bond long-only investing. And we can see that from this chart, which is quite complex, but what it's showing is the development of mandates. And if you look at the top left side, you can see the growth in the blue bars of the alternative asset management industry in terms of how much investors are investing in alternative assets. On the right-hand side, you can see the revenue side, so how managers are receiving revenue from those investments. They charge fees for what they're doing, and alternative assets make up almost half of the revenues of global asset managers. I think that just about finishes my summary, and I'm going to hand over to my colleague Lisa, who's going to talk about finding good asset managers.